Today we are going deep into Netflix stock. I'll give some insights on their updated financial statements, show you what my main pros and cons for the stock are, and calculate its valuation in order to figure out if the current price is a buy. Hope you enjoy the video, and if you do, click on the subscribe button for more. Before we get into the financial statements, let's quickly go over their highlights for the past quarter. Netflix was expecting to add 1 million subscribers, and instead, they more than doubled that, adding 2.4 million. They also beat on revenues and earnings. Revenues were $7.9 billion against $7.8 billion expected. And EPS was $3.10, 46% higher than the $2.13 expected. They did give a bit of a low guidance for next quarter, saying the appreciation of the US dollar is a significant headwind, but on a constant currency basis, their revenue growth should equate to 9% year over year. Management seemed pretty confident going forward. They said they are very optimistic about the new advertising business and that after a challenging first half of the year, they're on a path to re-accelerate growth. By the way, if you haven't heard yet, Netflix is launching a lower-priced ad-supported plan in 12 countries in November. I'll talk more about it later on this video. Moving on to the financial statements. Netflix holds a cash balance of $6 billion. Considering they don't have a very healthy cash flow history, being negative most years, and that they have a $14 billion debt, I personally would like to see a higher cash position here. In case they go through a bad phase or have the opportunity to do an acquisition, they will have to dilute the crap out of shareholders raising money. If you watched my previous videos on big tech companies, you know that in general they all have much higher cash than debt, with the exception of Apple, due to its specific strategies. Looking at their historic cash and debt balances, we can see that's not something new. They've been increasing their debt since 2016. One great thing to see here is that they lowered their debt position by 15% in the last 9 months. Especially due to interest rates getting higher, I think companies should try to reduce their debts as much as possible. So, although it's not the best scenario in my opinion, it's not a big red flag, since they seem to be managing this part well. The last relevant item I want to point out in the balance sheet is the content assets. That relates to investments already made both in their licensed and own produced content. This is the main reason Netflix's cash flow looks so bad in comparison to their profits. They have to spend a great amount of money in advance and only see the cash benefits after long periods of time. We can clearly see in the cash flow that they always spend more than the amortization amount. Usually companies' earnings and cash flow generated are pretty close, but for Netflix, these two are very different. In case you are a little lost, let me try to quickly explain how it works and why there is such a big difference. When Netflix purchases a licensed content or produce a new movie or series, these costs go to the balance sheet as a content asset. After the content goes public on their platform, this balance is reduced gradually through amortization that turns into an expense on the income statement. In accounting, the cash flow statement starts from net profit or loss. It then adjusts all non-cash events that affected the income statement and also the cash items that didn't. The amortization we see here in the cash flow is the expense recognized in the income statement, paid in prior periods. As for content additions, they go straight from cash to content assets in the balance sheet. Although Netflix has been profitable for a while, the only year in history where operating cash flow was close to profits was 2020, when they had to shut down their studios, which lowered their content additions substantially. Going to the income statement, note that even though they put Q2 numbers in the table, all my analysis will be comparing Q3 of 2022 with Q3 of 2021, the first and third columns. Netflix total revenue for the quarter was $7.9 billion, a 6% increase when compared to the same quarter last year. The big problem here is when we do the same analysis for costs and expenses. Cost of revenues increased 14%, technology and development 17%, and G&A expenses 16%. These unbalanced changes made operating margins drop from 23% last year to 19% now. To finish up the financial statements, we have the cash flow. We already talked about my main points here, the additions and amortizations of content assets, as well as their negative track record. The only thing left I have to point out is that their operating cash flow had a huge increase this quarter when compared to the same quarter last year. This is really something good to see. Before we get to the valuation part, let me show you the main pros and cons I see for the stock. Some of these I already commented, so I'll just quickly list them when it is the case. Netflix has by far the most amount of subscribers in the space. 228 million subs, representing 25% of the total market, while the runner-up, Prime Video from Amazon, has 20% market share. To lead in a market with so many great competitors and maintain a growth on subscribers of 20 to 30% in most years, they have got to be doing a lot of things right. And always, when companies have the majority of a global market, they get into very favorable positions and deals. One example is their new ad tier. According to the company's management, interest from advertisers are very high. Most companies want to advertise on the platform that almost everybody in the world spend daily hours on. And as they have partnered with Microsoft for the advertising technology, have all kinds of content, and a lot of user data, I imagine they will be able to do a great work targeting these ads. The best content for adults. Although there are a lot of competitors in the space investing crazy amounts of money, even more than Netflix, I believe their content is still the best, at least for adults. I have Prime and Disney Plus as well. They do have great content, but it's kind of limited in my opinion. If I had to choose one service, I would easily cancel them both before canceling Netflix. I can't say much about the kids' content. I got a 5-year-old nephew, but he is addicted to YouTube. Not even Disney Plus gets his attention like some YouTubers do. There are two main characteristics I see in Netflix business model. I'll talk about the positive here and the negative on the cons. What I really like about it is how predictable it is. Being a monthly subscription service that gives a lot of value to customers for its price, Netflix has very low churn rates, revenues are steady and reliable, what allows them to have confidence in investing a lot of money and to keep that low cash position in relation to its debt. Like I mentioned in the beginning of the video, Netflix is launching a lower-priced ad-supported plan. The idea is to charge a little less, include ads to make up the price difference, and with that, get more subscribers. Their basic plan without ads today is $10, and they will charge $7 with ads. I'm sure they did a good market analysis to get to these prices, but it doesn't seem to be enough difference to convince a lot of people. I don't know if people that don't want to spend $10 will spend $7 to get shown a bunch of ads every 5 minutes. This is actually a big question mark for me. Let me know in the comments what you think. Moving on to my main concerns for the stock. As I said while analyzing the balance sheet, their debt is a little high, considering they rarely generate free cash flow and have a much lower cash position. Same thing with their negative cash flow situation, as I already talked about it earlier in the video. Let's move on. The third con is the business model part I don't like. Being a streaming service, they have to purchase licensed content and also produce their own. Both cases cost a lot of money, making their margins very low. Usually software companies have gross margins ranging between 75 and 90%. Their gross margin is around 40%. This ends up hurting their profit margins that are currently at 19%. Let's compare with other big tech software companies. Meta's profit margin is 32%, Google is 27%, and Microsoft 25%. Streaming is nowadays one of the most competitive segments in the market. Not only there are a lot of competitors, but they are also the heavyweight kind. Netflix is currently competing with Amazon, Apple, Disney, Warner and many more. And although Netflix is the clear leader in the space, their situation is not the best. Different from Amazon, Apple and Disney, Netflix is a one-trick pony, meaning they have one product, one source of revenue. If there is any problems in this segment, Netflix doesn't have the business diversity others have to keep investing and making great content. They are also not able to capitalize in their successes like Disney does with their movies and characters. When Disney does a great movie, they have related attractions in their parks bringing more people, they sell a bunch of merchandise, they launch it in the theater, and they license the characters to other companies. Netflix can't do all that. And they don't have other services to create an appealing bundle like Amazon Prime or the Apple one, where for a similar price as Netflix, you get movies, series, sports, music, gaming, cloud storage and more. In regards to the smaller players, they are not that small and are getting together, trying to form a big group with a library interesting enough to compete head-to-head with Netflix. I feel like people are getting sick of so many subscriptions they have to pay, and I think in the near future, we will have an option for a bundle with all the streaming services, which would probably decrease Netflix revenues per subscriber. Basically everybody I know either has a Netflix subscription or uses a shared account with someone else. As they don't work in China, I'm not sure if they still have much to grow in terms of subscribers. And in terms of price, they already are the most expensive option in the market. It's a pure entertainment service, something anyone could cut during a recession. Since it's also one of the cheapest ways of entertainment, I believe they would be able to manage things if we go through a long recession. But still, considering the current macroeconomic scenario, I have to consider it as a con. Okay, now that we know more about Netflix's business and its current situation, let's play with some numbers and see how the current prices compare with my buying targets. In order to do that, I'll estimate a few variables considering the next 5 years. They are revenue growth, share change, profit margin, PE ratio, and expected returns. And I'll use 3 different scenarios. The base case, where I use my most realistic assumptions. On the best case, I'm more bullish. And for the worst case, I go with more conservative numbers. For revenue growth, we can see Netflix has an incredible track record, really impressive how they managed to grow significantly every single year for the past 10 years. But as we mentioned throughout the video, their subscribers' growth has been slowing down, competition is increasing, and their prices are already the highest in the market. So I don't expect the same growth level they had before. I think things go well, they might increase 10% per year. If they do an amazing job, maybe a 13% on average is achievable, and in case things go south, let's say 7%. Looking at Netflix shares outstanding for the past few years, we can see there is almost no change, less than 1% change per year, and this year it actually decreased a little bit. So I'll do 0% change in all scenarios, considering there won't be any relevant changes here. On profit margin, Netflix has been increasing significantly over the last decade, which is great, but also normal for a successful startup after it achieves break-even. This kind of growth in margins will not sustain for a long time. Unless their subscribers on the new ads tier are more profitable than the current subscribers, something I don't think will happen, this margin will either stay around 19% or go lower. So I'll consider the same 19% for the base scenario. 21% for the best, assuming they still have room to improve, and 17% on the worst case, which I think it might happen depending on the ads tier. For price to earnings, as Netflix is getting more mature and slowing growth, its PE has been coming down over the years and is now 24, after a big drop to 16 a few months ago. For a company that has only one product, low margins, growth ranging from high single digits to low teens, and the biggest companies in the world trying to eat their lunch, I'd say 24 is a bit high. And remember that here we need to estimate what the PE will be in 5 years, when they will probably be bigger, growing at a slower pace. So, I'll consider 15 for the base case scenario, the market average. For the best case, where their sales grow a little faster and have better margins, I'll do 17. And 13 for the worst, where we considered only 7% growth and a small decrease on profit margin. For expected returns, I'll use 15% per year for all scenarios. It's a great performance when compared to the market average of around 10%. It also gives a good safety margin, in case I'm wrong. We now have all the assumptions, let's find out what a good buying price for Netflix would be. For the base case scenario, the one I think it's the most likely to turn out, we got a fair value of $220. This means that if our assumptions are correct, Netflix stock is overvalued by 24%. The price we got on the best case scenario is $301. If this turns out to be true, then Netflix stock price should increase 4% to get to fair value. To finish up, we have the worst case, but don't click out of the video yet. After revealing this scenario, I'll give my overall opinion. The fair value for the stock on the worst case scenario is $157, meaning the stock should fall 46%. Keep in mind that this is not financial advice. My overall opinion is that Netflix is a good company, but at these prices, when we have the whole market crashing, I believe there are better deals. Microsoft currently has a similar PE, growing faster and with a much stronger moat. Meta and Google are well below in terms of PE, companies I also think are better than Netflix. By the way, I'm leaving a link in the description for each video I made on these companies. Thank you for watching until the end, don't forget to subscribe, be careful out there, and I'll see you in the next one.